Okay, so section 3 is strategies for saving and investing. Okay, so we're going to talk about the concept of systematic saving and investing, and talk about how to lower your investment risk by diversifying and building your portfolio, and then how understanding the financial marketplace and the economy can help you maximize your returns. So systematic saving is a strategy that involves regularly setting aside cash that can be used to achieve goals. So the amount should be whatever you are comfortable with each pay period, or you could do it monthly if you're not, even if you're paid multiple times in a month. It is very convenient if you have it automatically set up when you get paid. And that doesn't have to be through your employer. It can be, depending on the savings account. But if you have direct deposit in your bank, you can set it up so that you don't even have to have direct deposit, but you can, every time you get a deposit, that so much, either a set dollar amount is put into a separate savings account, or you could just have it every 2 weeks that's taken out and done. So it should stay there in your savings until, assuming it is not your emergency fund, you can still have savings plans for your goals. Like maybe you're saving for a vacation and then you take that money out when vacation time comes. And once you meet all of those goals and have your emergency fund, that's when you should begin your systematic investing, which is a strategy that involves a planned approach to making investments on a regular basis. So when you first start investing, you typically want to start with your safer investments, which we'll get into in a few slides, and lower risk. And then your long-term focus. So systematic saving and investing are for the long term. It's designed for growth over time. So sometimes you have to hold on to your investments for 20 or more years to kind of get them to get the returns that you want out of them. So the book says, suppose your investments have grown at an annual rate of more than 7% over any 20-year period of time. That doesn't mean that in any given year you earn 7%. And in fact, many of those years you may lose, but overall you would gain more than 7%. So it's, again, the long run and focusing on your future. Investment tracking is a technique for making investment choices by following the prices of stocks and other investments over time. So you can look them up on the internet. You can use newspapers. I feel like most of you, your go-to will probably be the internet. And if there's a certain stock that's interesting you, you can track it, pay attention to it, maybe save your put it all into some sort of spreadsheet, make a chart, which we're going to look at on the next slide. And you can see what that stock is doing to see if it's kind of what you want before you actually invest in it. So you can look at the trends of what's happening. Market timing is buying and selling stocks based on what the market is expected to do. So there are stockbrokers and analysts that they make their living off making these predictions, buying and selling investments for people, what they feel is right. They look at trends of kind of the overall economy and what's going on. We've talked about market timing. The problem with market timing is it is very risky and can be difficult. Not all worldwide events and what's happening in the economy can actually be predicted, right? Things come out of nowhere. And so then if they're not predicting them, you may end up on the losing end. This is a chart here that shows a stock price over the years, over 12 years. So you can see if this was your stock, you bought it at around $50. Actually, I'm not sure why it doesn't show year 0. I would assume that's when you had bought it, but that's okay. So it's $50. So if you sold this after 5 years, or at year 5, you're losing money, right? Because it's down at about just over $45 then. But if you hang on to this in the long run, after 12 years, it's up and worth $65. So depending on kind of when you zoom in on this, it may be good, it may be bad, but in the overall, this has gone up quite a bit, almost 30%. It's gone up, I think, in those 12 years. So that's a great return. And there's also what's called dollar cost averaging, which is investing the same amount of money on a regular basis, regardless of market conditions. So this is a systematic investing strategy. So it could be that every paycheck is $50. On the first of every month, it's $200. It does not matter if stocks are doing really well or really bad. You're putting that same amount in all of the time. So sometimes you might be able to buy more shares and sometimes it would be less shares. So you don't have to try to study the stock market to determine when the best time to buy is, because you're going to be buying regardless of how it's doing. So systematic saving and investing is a long-term plan that involves making regular deposits in savings and making planned investments. And there's different investment strategies that you can choose. So how can you reduce your investment risk? So all investments are risky. That was something I did grade last week's homework from 10-1, kind of how's investing different from saving. Investing is the potential to make more money. It is not guaranteed. You are not always going to make more money off of your money. So keep that in mind. Some people kind of didn't make it sound that way. I didn't mark it wrong for that, but just know you can lose your money. So to reduce your investment risk, you want to diversify your portfolio. So diversification is holding a variety of investments for the purpose of reducing overall risk. Because if one type of investment isn't doing well, sometimes the other ones will. And then a portfolio is a collection of investments. So to lower your risk over time, you want your portfolio to be diversified. So this is an example or a picture from your book. So when you start building your portfolio, you want to start with a strong foundation of safe investments. So some examples there. Savings account, CDs, treasury bills. Then when you feel like you can take more risk, you can go to some of those low risk investments, the mutual funds, government bonds, high grade corporate bonds. And then again, moving up to those growth investments, growth stocks, mutual funds, real estate, and then speculative investments, options, commodities, venture capital. So speculative investments have high earning potential, but carry a high risk as well. Next chapter, we're going to look at low, medium, and high risk choices. So you don't need to kind of memorize this right now. We're going to look into those more in depth. But the idea is that over time, your portfolio should gain value at a rate higher than inflation. But you would want to decide how much you want at each of these levels. It is up to you. There's no one set way to do it. And then can you maximize your investment return? Because ultimately that's what you want to do. If you are investing, you want to make money and to maximize that. So the financial market, we've talked about, I believe already, any place where investments are bought and sold. I guess we haven't defined that yet. But if you understand the economy and how it affects the financial market, that might help you make better investment choices. And better to you might not be better to somebody else. So the economy is always going to have periods of growth and decline, and different people feel differently on when they want to buy and sell and invest and how much they want to put into it. So a bull market is a prolonged period of rising stock prices and general feeling of investor optimism. In that time, investments are often growing, profits are good. If investors think that the economy is going to continue to grow, some of them may buy stocks during a bull market. Other people like to sell stocks during the bull market because they bought them at a lower price and then can sell them to make a profit. Bull markets typically, it said they can be anywhere from several months to several years. Bull markets are much longer than bear markets. They're typically 3 to 5 times longer. Bear markets are short and savage. Your book describes them. So it's a period of steadily decreasing stock prices and investor pessimism. So when the prices are falling in a bear market, they are often falling quickly, a sharp drop in price. And so again, people feel differently. Some people like to sell then because they panic and things aren't going well. Some people like to buy when prices are going down because they're going to get more for their money in hopes that it will go back up. So depending on where you are in your comfort level with stocks, some people will hire some sort of financial planner to help them, some stockbroker. You want to make sure you have similar views to whoever is going to be handling your money. If it is not you doing it directly, if it's you doing it directly, awesome, but there's you may want to do a lot of research and staying caught up on it. Some people don't feel like they have that time, so they hire someone to do that for them, but make sure who you hire aligns with how you feel. Do you feel like a bull market is a time to buy or a time to sell? Do you feel like a bear market is a time to buy or a time to sell? So keep those kind of things in mind. Again, bull market is going up, bear market is going down, and it often goes down quickly. So that's the difference there. And that is it on our slides for today.